Friends, welcome. Today, let us discuss this topic, error and fraud in the context of audit. So far, friends, we have understood that auditor expresses an opinion on the financial statements, right? We know that's the key objective. That's the main objective of audit, is to express an opinion. Now, friends, please tell me, this opinion is about what? What is that opinion is about? Can anyone tell me? The opinion is on the financial statement. And it is about whether this financial statement is showing a true and fair view or not. Okay. Whether it is showing a yes or no?
Yes, sir.
Yes or no? Yeah. Finishing it is
Yes,
showing true and fair view or not. Financial statement will show true and fair view only when there is no error, no fraud, which is material. That means even if there is some error and fraud, still financial statement can show a true and fair view if they are immaterial. So in that context, to give this opinion, we have understood the concept of materiality. So auditor can say it is showing true and fair view, keeping in mind the concept of materiality. Okay. And the financial statement will not show true and fair view if it contains some misstatements. The related term here is that we have to consider the misstatements. If there is some misstatement in the financial statement, can it be called as, can you say that it is still showing true and fair view? What's your opinion? If there is a misstatement in the financial statement, let us say let us say there is a misstatement in the financial statement, or there is a omission in the financial statement. Can you say it is still showing true and fair view? Is there any possibility? Then even if financial statement contains some misstatements, it is still showing true and fair view.
So partially yes.
Partially yes. How?
So because in case of auditor, his work is just to see whether it is everything is perfect in their aspect or not. If you will see the financial statement is done by the company, and it was the totally fault of the company, not the auditor. And there the auditor cannot mention it here are the mistakes you have done for that. Everything is wrong is happening. So partially you can say auditor opinion is right, but the actual thing is wrong.
Okay, but after all, auditor is giving an opinion about truth and fairness of the financial statement. But rather, I will put it differently. I will say, even if there is a misstatement, financial statement may still show a true and fair view, provided these misstatements are not material. Okay, if they're not material, or if it is not affecting the economic decisions of the users of the financial statement, still financial statement may give true and fair. Misstatements are there, but they're not material. Understood? This is the concept we are discussing in our previous session. Is it not? Even if there is some error, still financial statement may be considered as showing true and fair view. Okay, are you agreeing with me?
Yes, sir.
Okay. Now, when we're talking about the financial statement, we have to see it is showing true and fair view, and it may contain misstatements, and this misstatement has to be evaluated on the basis of materiality. Now, next question comes, why at all there is a misstatement in the financial statement? The misstatement will be in the financial statement for two reasons. Broadly, either it may be error or it may be what? What is the other one?
Fraud.
Fraud. Now, let me once again tell you, if there is an error and fraud, if it is material, it may lead to a misstatement, which will affect the true and fair view of the financial statement and which is going to affect the auditor's opinion. Are you able to connect these concepts?
Yes.
If you try to join the dots, there might be error or fraud in the financial statement. If it is immaterial, it doesn't matter. If it is material, then you'll say it is a material mistake. If the financial statement contains a misstatement which is material, it doesn't matter whether it is due to error or fraud. It will going to affect the true and fair view, okay, of the financial statement. And auditor will give an opinion that is not showing true and fair. It is going to affect the auditor's opinion. Therefore, when the auditor is verifying or applying such audit procedure, he is interested to find out what are the errors, if at all there is some fraud, and what is the impact of that. Okay, what is the impact, keeping in light the concept of materiality. Okay, now I think we'll be able to understand why at all we are learning this concept and why this topic, error and fraud, is important for us. Now let us start that topic today. Okay, friends, are you ready? Now let me share the screen with you. Yeah, one more thing. Here also we'll be talking about the responsibility of the auditor as regards to error and fraud. That means if there is an error or fraud, what is the responsibility of the auditor? What he should do? And in which situation auditor may be considered as negligent. That means auditor has not performed his duty properly. Okay, so that is also important. Okay, understood? Right. Now, what is coming to your mind? Would you like to think a while and tell me what may be the difference between error and fraud? Is there any difference, or they are same thing? What is error? What is fraud?
The error is something which is happened unintentionally because of some exchange or something, and fraud is done by like intentionally to show something wrong figure or something.
Okay. The normal understanding is that normally we understand that thing, that errors are unintentional and frauds are intentional, but there might be exceptions to both the situations. But the normal understanding is what you are saying, that is absolutely right. That errors means generally they are unintentional, and frauds means someone is purposefully in a planned manner doing it. Okay. Now let me share the screen with you. Let us understand the implication of this thing in the auditor. So financial statements are prepared by human beings. Human element is the most significant element in recording and processing the financial information and converting the accounting data into a financial statement. It's done by human beings. Even if computer helps a lot in the processing, but decisions are taken by human beings, and the basic data has to be fed by human beings. And from the very beginning, we know the objective of the audit is to express an opinion on the financial statement. Objective of audit is not to detect error and fraud. Error and fraud is not the primary objective. Okay, it may be one of the incidental objective or secondary objective. Because if error and fraud is there, then auditor may not be able to form an opinion. If these error and frauds are material, therefore, that may be detection of error and fraud may be a secondary objective or an incidental objective, but that's not the primary objective. Primary objective is only to express an opinion. And here we are talking about statutory. This objective may be different for internal audit. Objective of audit may be different if it is a forensic audit. Okay, objective of investigation is also different. But here, when we're talking about the statutory audit, so detection of error and fraud is not the primary objective. But at the same time, you have to appreciate that no account can be considered true and fair if substantial errors and frauds remain. If the account of the financial statement contains some error and fraud which are material, so material that it may distort the picture. Distort the picture means distort the truth and fairness of the financial statement. Because of those error and fraud, financial statement may not be showing true and fair view. Okay. So no account can show true and fair view if there are substantial errors and frauds. An auditor's objective is to express an opinion. So before that, he has to form an opinion. And for forming an opinion, he applies certain audit procedure and audit techniques. And if these techniques and processes are properly carried out, then it will definitely bring into light errors and frauds, even though the examination is not specifically directed to reveal them. Okay, that means auditors for audit procedures are not specifically directed to detect error, but in spite of that, error and fraud can be detected. Okay, if audit procedures are conscientiously applied. Okay, so incidentally they'll be. But if you ask me whether the techniques should be directed to detect error and fraud, answer is no. These techniques are directed to collect some evidence so that auditor can form an opinion on the financial statement. Okay, are you with me up to this?
Yes, sir.
Now you see, it is entirely the responsibility of management to ensure that there is control over this error and fraud. That means there should be a proper internal control system. This internal control system needs to be installed by the management in order to ensure that the financial statements are reliable. So responsibility lies with the management. Management is responsible. But when auditor applies a procedure, auditor may discover some area where control is not foolproof or inadequate. Okay, let us say auditors has applied a procedure vouching, or let us say applied a procedure of reconciliation or debtors confirmation. Or just say, okay, you are saying showing so much of debtors, let me get confirmation from them. Okay, auditor asks the letter confirmation letter. Auditor send the debtor confirmation letter through the client to the debtors. As per my books of account, this is the amount payable by you. Please confirm it. Auditor is sending this thing. And auditor got replies. Let's say 100. Auditor has selected a sample size 100. It has sent to 100 debtors. 100 debtors got reply. And not a single one is matching. That means what? This financials, these books of accounts of this client, this particular entity is doubtful. Because what the client's books of accounts is saying, what the entity's books of account is saying, the debtor's books of accounts are different. Okay. Is it done? So auditor applied a normal audit procedure. Is it not? Debtor verification is a normal audit procedure. But in this process, auditor found out something which shows that internal control in the area of debtor management is weak. Because client's ledger balance and the other party's ledger balance is not matching almost in 100% of cases or 50% of the cases. That means there is no control over this. Are you getting me? Yes or no? Are you getting the point?
Yes, sir.
So what the auditor did? Auditor applied a normal audit procedure of debtor confirmation, but found the mistakes. Okay. Let us say auditor applies some other thing. Let us say auditor applies a procedure called as bank reconciliation. You'll say, okay, show me the bank reconciliation statement. Let me see how frequently you are reconciling your banks. Auditor found bank reconciliation statements are there. It is prepared. But it has found in the bank reconciliation statement itself, there are several items like checks issued but not presented for payment. Okay, there normally this is the item in the bank statement, is it not? Checks issued but not presented for payment. This kind of items you find in the bank statements. So when checks has been issued, in the entity's bank account, balance is reduced. But exchange checks are not presented, balances are not reduced in the bank. So there is a difference between the bank balance and the bank account balance in the client's ledger. But that's fine, reconciliation has identified that area. But if your auditor finds out that out of this checks issued but not presented, there are so many checks which are stale checks, in the sense they have been issued prior to 3 months or prior to 6 months. And you know the validity of the check has already been expired. Even if the person finds that check, he will not be able to encash it because the debt has been expired. When debts are expired, ideally that entry should have been reversed because these checks are not no more payable. But if it is still shown in the bank's reconciliation statement, that also shows that bank reconciliation statement, that is the control over the preparation of the bank's reconciliation statement, is inadequate. Are you getting my point? So when auditor carries out the normal audit procedure, he may find out many areas where controls are weak. Okay, friends. And for that, it may provide practical solutions. It may give you practical. Every year you do a bank reconciliation. Every year you find out, or every month you find out. Every month you do a bank reconciliation. Every month you find out what are the stale checks and past revers, and or every quarter, every half year, you send a debtors confirmation letter to the debtors. If there is some difference, get it reconciled. So these are practical solutions. So auditor may provide practical solutions which may work as a defense against charge of negligence. Tomorrow, nobody should say the auditor that you are negligent. Auditor may say, you see, there was weaknesses in the internal control system. Management is responsible for installation and maintenance of the internal control system. I had found weaknesses and I had communicated it to the management that in this area control is weak, please take care of it. Okay, friends, are you getting me?
Yes, sir.
Now, many times, many cases you see, you have heard all big scams like last year, big scam. Even at that time, our finance minister was asking in the newspaper also, who was the auditor of this company? So many times this was asked whenever there is a scam, there is a fraud. People ask, who was the auditor of that company? That is, who has authenticated, who has attested the financial statement? Who has said that the financial statement is showing front there? Okay, people point their fingers at the auditor. Now, question comes: how to know that whether that auditor was negligent or not? On the one hand, we are saying it is entirely the responsibility of the management to prepare the financial statement and ensure that the internal control system is in operation. Auditor has to apply routine audit procedures. Frauds or mistakes may incidentally be discovered, but audit procedures are not specifically directed for detection of fraud and error. In that situation, how to know auditor is actually guilty or negligent or not? These few points will help us to take decision in that kind of situation. Number one point, this you have to read with me. Please, some of you please read first point number one.
Whether the auditor has exercised reasonable skill carrying out his work.
Here, the question is that whether the auditor has exercised reasonable skill, minimum skill which is reasonable. Let us say auditor has seen the bank balance. Okay, auditor has seen balance as per bank is this one. Whether auditor has asked for bank reconciliation, whether auditor has asked for a bank balance confirmation certificate. This is a reasonable thing auditor has to do. You also know the professional concept of professional skepticism. Earlier we had discussed this thing. Auditor is expected to be skeptical. Whether he has asked, if he has not asked, then he has not exercised the reasonable skills. Let us say in the books of account or some evidences there is a correction. And it creates a doubt in the mind of anybody that there is something wrong. So whether auditor has tried to confirm that. Let us say client is saying, I have paid this much of tax. Whether auditor has verified the payment challenge. So what is reasonable? That's again, it's a matter of judgment. But here you have to see that we have to check. Auditor has to prove that he has exercised reasonable skill while carrying out his work. If he has exercised reasonable skill, but still there is some error or there is some fraud, then auditor is not negligent. For example, let us say you are the auditor of an entity. Client shows my bank balance is 5 crore. Okay, are you getting me?
Yes, sir.
Or say client says that 5 crore is receivable from that particular debtor. From that particular debtor. So you may ask a bank confirmation. A client has given you fraud or fake bank confirmation. Or you ask a bank statement, show me the bank statement. A client has given you fake bank statement. Or client has also given you fake bank's balance confirmation certificate. You relied on that. Because internal control system is after all the responsibility of the client. So client is giving means you relied, that's okay. But actually that's a fraud. Whether auditor is negligent, what do you feel? What do you feel? What's your opinion? Negligent or not?
Yes, sir.
Yes means negligent.
Yes,
I'm
sir.
giving you example one thing. Let us say you are the auditor of an entity. You found there is a fixed deposit of 1 lakh. You ask the client, how can I know that it's a fake deposit? Show me the deposit certificate. Client showed you deposit certificate. Incidentally, that is a fake. And you also found, okay, deposit certificate is there. Client is saying you verified, it's okay. Whether you'll be considered negligent in this case. How to take a decision here? You have to see whether you have exercised reasonable skill or not. Okay, whether you have exercised reasonable care or not. Now, the reasonable care is that if there is a deposit, you should have asked for evidence. You asked for evidence. You found the certificate is there. You believe that, and you formed an opinion that that item is showing true and fair view. Now, in that situation, will you be considered to be negligent?
No, sir.
Not maybe, sir, because he should have done.
No. Why no? Because you have evidence that you have taken reasonable care. Okay, fraud has been committed, and you have applied normal audit procedure. Your audit procedure is not specifically directed to detect a fraud. You have exercised normal audit procedure, and you have exercised reasonable skill and care, and you found an evidence and you are satisfied. It's perfectly okay. In that situation, auditor will not be guilty, will not be considered to be negligent. Now come to second.
Whether errors and fraud were such as could have been detected in ordinary course of checking without any special effort.
Okay, let us say there is an error or there is a fraud that could have been ordinarily checked without any special applying any special audit procedure. Anybody could check. Okay, you are saying there is a balance with debtor something, and bank client is showing the certificate. It appears there is some correction, there is some overwriting. It appears that it is fake. That means anybody could find it out. And still it has not been found. That means auditor is negligent. But it is such a nature that nobody can doubt that certificate, fixed deposit receipt is shown to you. It is perfectly original. Nobody will doubt that. Then you are not negligent. If there will be some doubt, then you may be negligent. Understood the second point? Did you understand?
Yes, sir.
Yes, sir.
That means we have to see whether the errors and frauds were such as could have been detected in ordinary course of checking without any special effort. Any ordinary man could detect that error, but still auditor has not found it. Then auditor is responsible. But it is such that it could not have been detected in ordinary course of checking, then auditor is not negligent. Now, point number 3.
Whether
What?
auditor had any reason to suspect the existence of the error and fraud.
Yes, this is a very interesting thing. Is there a reason that auditor should have suspected? No, this can't be. There is some error and fraud. Okay, there is a reason to suspect, but auditor has still not suspected. In that situation, auditor is negligent. But there is no reason to suspect. Then auditor cannot be held negligent. Understood? Okay. Auditor sees, let us say auditor sees company is borrowing loan at high rate, 16% rate it is borrowing. It has bought 16% rate. And company was desperate to borrow loan from them. Okay. And at the same time, auditor find financial statement shows fixed deposit. Company has also deposited money in the bank at the rate of 6% interest. Now tell me, is there any reason to doubt? When the company is borrowing money, that means it has no money. It is borrowing at 16% interest. Why at all at the same time it is kept as a fixed deposit at 6%? Okay, there is a possibility that money may not be there. Money might have been applied elsewhere and it is shown as fixed deposit. Understood? Here it shows there is an indication that there might be something wrong in this financial balance, in this account balance. Okay? Understood? There is a reason to suspect the existence of error and fraud. There is some reason to suspect. Got it? Now, point number 4. Please read it.
Whether the error and fraud was so deep laid that the same might not have been detected by application of normal audit procedure.
The error and fraud are deep laid. It is planned in such a way that when you apply the normal audit procedure, you will not be able to detect it. It is so deep laid. It is properly planned. Okay. Okay, let us say some asset has been purchased. It is properly planned. It's a fraud. Actually, asset has not been purchased, but still there is a proper plan. How? What kind of plan? Properly approved. Okay, all people have signed. All the documents you see is proper. That is a deep laid fraud, properly planned fraud. If it is properly planned fraud, then normal audit procedure may not be able to detect. In that case, auditor will not be held negligent because it's a deep laid fraud. But fraud is such that it's not deep laid. It can be, anybody can find it out that it's a fraud. In that case, auditor is negligent. Understood? Yes or no? Now, what I explained you all these things, you can have a look at this chart. With the help of this chart, one can test an auditor's performance, whether auditor is negligent or not. We have to ask these 4 questions in fact. Whether auditor has exercised reasonable skill. Could that misstatement have been detected in ordinary course of checking? Was there any reason to suspect? Is the fraud deep laid? If there is, auditor has not exercised reasonable skill, he is negligent. But he has exercised reasonable skill. But fraud is such that it could have been detected in ordinary course of checking. Yes, it could have been detected in ordinary course of checking. Yes, auditor is negligent. But no, it could not have been detected. Then let me ask the 3rd question. Was there any reason to suspect? Yes, there was a reason to suspect. Then auditor is negligent. Was it so? Was it a deep laid fraud? No, it is not a deep laid fraud. One can find it out easily. Then auditor is negligent. But if it is say exercise reasonable skill, yes. Could have been detected in ordinary course of checking? No. Was there a reason to suspect? No. Was it deep laid? Yes. Then auditor is not negligent. Understood? Now have a look. And please tell me whether you'll be able to understand this concept. Did you understand?
Yes, sir.
So a practical situation might be given to you. This is the financial statement. This is what happened. Now in that situation, you have to apply that what is the misstatement, whether the misstatement is due to error and fraud, what kind of reasonable skill you are supposed to exercise, whether the fraud is deep laid or not. Keeping all these things in the mind, you might have to decide whether as an auditor you may be negligent or not. Okay, this chart is in fact the guideline to test whether auditor is negligent or not. Okay, so friends, as I told you right now, there may be misstatements in the financial statement, and there are various reasons and circumstances of these errors or fraud. And these misstatements, what we're talking about, misstatements may arise due to 2 reasons. What are they? Only 2 reasons, either error or fraud, that may lead to misstatement. Now let us understand what are the circumstances of these 2 things. In which circumstances there might be error and fraud. And in case you find circumstance exists, then what as an auditor you are supposed to do? You are expected to be more careful, because you are saying there is some circumstances, and in these circumstances error and fraud can be expected. Okay, now let us see these circumstances. Let me show you this slide now. First of all, ignorance of generally accepted accounting principles, account classification, and need of reconciliation. Sometimes we find this. The client is not aware of the accounting. So that may lead to mistake. Let us say client doesn't, the entity doesn't know how to value closing stock, how to value inventory. Client doesn't know how to provide depreciation. The manner he has not understood properly. Then this ignorance will lead to a misstatement. There can be error. Isn't it? Client doesn't know the importance of reconciliation. There is a need to reconcile the account balance. Client doesn't. So he is not reconciling. So it may lead to errors. Second circumstances, you are finding carelessness in doing accounting part. The staff members of the entity are careless. So that may lead to error and fraud. It may weaken the control. Fraud is possible. What is the 3rd reason? Will you read it? Point 3.
Desire to conceal effect of defalcations or shortages.
There might be defalcations or shortages. Let us say something like this. Client staff knows there is a shortage of stock. Stock is missing, the stationery is missing, some asset is missing. So they want to hide it. Otherwise, one person may be held accountable for that. So to avoid that thing, someone may enter a fake sale or fake entry for destruction of the item, scrap, all this. So these are the frauds. Purposefully someone is doing, intentionally someone is doing. Why he is doing? Because you want to hide the defalcation. There is a cash defalcation or misappropriation of the cash. Somebody has taken that cash. Now, to avoid the accountability, what one person can do? Maybe book a fake expenditure. Understood? So that is one more circumstances where one gets fined, fraud, and error. Then fourth one. Can you read? Yeah, tendency. Tendency of the management to permit prejudice or bias to influence interpretation of the transactions. So management tendency is such that it is permitting its own bias to interpret the transaction. Okay. So let us say transaction is recorded, transaction is regarded as something. It is regarded technically or legally, it will be recorded as sale or supply of some goods. Or management is arguing, no, it is, or it has got some own logic, which is not acceptable. No, it is not supply. Since it is not supply, it will not be considered as, let us say, for GST liability. Management is biased. Tendency of the management is to support his own bias. So that may lead to error and fraud. Okay. Understood this thing?
Yes, sir.
Okay. So this is one more circumstances. Tendency of the management to permit prejudice or bias to influence interpretation of the transactions. Fifth reason is to minimization of tax. Entity wants to minimize tax. How it can do it? Either it may hide some sales or enhance some expenditure so that profit will be less and tax will be less. Then one more circumstances is that intentional effort committed by a person in the position of authority to show up the picture depicted in the financial statement, or maybe to depress the picture depicted in the financial statement, or convert an error to personal benefit. Sometimes people want to show up the picture which is depicted in the financial statement. Financial statement shows low profit, they want to show high profit. Okay, intentional effort. Some efforts are intentionally done because person is in the position of the authority to show up the picture. Okay, suppose sales is this much. Sales is, let us say, 5 crore 98 lakh. He wants to, okay, let me make 2 crores more so that it will become 6 crores. So that people will remember me that I am the director of finance of the sales, let us say, the director revenue. So people will remember that in this period, revenue has cost 6 crore. So what he is doing? Some of the months of sale of April is booking in the month of March, preponing the transaction. Is it an error or fraud? For his one personal benefit, he may get a promotion.
Fraud.
Yes, purposefully someone is doing. Okay, transaction which is actually in should go in the month of April, that is booked in the month of March to show up the picture. Maybe by showing that he may get promoted. He may be promoted. Sometimes to show down, actual figure is more, they want to show down. Why to slow down? Most of the cases it happens to avoid tax. There might be other reasons also. Okay. Actually, company is in better position, but they want to slow it little down to depress the position. So this just things purposefully done, but who can do it? Only influential people who can influence that financial statement preparation process. The people having authority, they can do it. This is not a fraud which happens at the lower. This is a fraud which happens at the higher level. And one has to understand in these circumstances, this kind of fraud is possible. Now, third reason here is that convert error to some personal benefit. This also I explained. If there is an error, there is a possibility of personal benefit out of this. Okay. Somebody may show that performance of the company is very good so that he can get more bonus. Okay. So all these things are possible. Okay. So these are some circumstances of error and fraud. Did you understand this? After this,
Yes, sir.
now friends, few more things about error and fraud we need to understand. Coming to the types. As you can see, there are some errors which are self-revealing in nature that automatically it can be found out. Some are unintentional, some of them are intentional, some of them are unconcealed, some are concealed. Some errors affect the general ledger balance, some do not affect general ledger balance. You may call them as procedural errors. So all these things will be learning, self-revealing errors, etc. in due course. And what is again fraud? What kind of frauds are possible? That is also important for us. So we'll be learning about this thing. There is one more category of errors like errors of omission, commission, compensating error, errors of principle, procedural errors. We'll be learning. Okay. Then what is the situation in which fraud is expected? Okay. Risk factors of fraud. These things also we'll be learning. Okay. So these are few more things we need to understand in the context of error and fraud. So we need one more session on error and fraud. After this, do you have any query? You have understood whatever has been taught to you?
Yes, sir.
Yes, sir.
Thank you very much.